Hello. We're now moving on to a major new topic, investment appraisal. This is highly examinable and is at the core of financial management. The financial strategy contains three key decisions. The finance decision, where do we get our money from? The investment decision, what do we spend it on? And the dividend decision, do we return our money to our investors or do we retain it to reinvest? During this part of the course, we're focusing on the investment decision. What do we spend our money on? Let's start off by making a key assumption. We're going to assume that we're trying to maximize the wealth of the shareholders. There are many reasons why businesses may invest: to secure growth, to achieve a non-financial goal or social purpose. But we're going to assume the deciding factor behind do we go ahead or not is, will it create wealth for the shareholders? If it will, let's go ahead. If it doesn't, let's not. There are four main investment appraisal techniques examinable. Two involve a process called discounting, building in the time value of money, and two do not. The two that don't involve discounting are the accounting rate of return, or ARR, payback period, or PBP. The two that do involve discounting are net present value, or NPV, and internal rate of return, or IRR. We'll start off with the non-discounting techniques, then work through the ones that involve the time value of money. We'll then go on to develop net present value techniques for longer questions. So, let's begin. The accounting rate of return is the percentage return a profit generates on average per year. It's also known as return on investment. The formula is as follows: average annual profit from investment over initial or average investment, where average investment equals initial outlay plus scrap value divided by 2. Our examiner prefers to divide by average investment. This will be specified in the question. So, suppose for example a potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000, Year 3, $600,000, and Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. Let's calculate the accounting rate of return based on average investment. Remember the formula: average annual profit from investment over average investment, times by 100 to give us a percentage. Average annual profit refers to accounting profit, so after depreciation. Total cash profits would be $300,000 plus $550,000 plus $600,000 plus $440,000 equals $1.89 million over the 4 years. Total depreciation would be the difference between initial cost and scrap value. So $1.7 million minus $200,000 is $1.5 million. So total profits after depreciation would be $1.89 million less $1.5 million depreciation is $390,000, or $390,000 divided by 4 is $97,500 per year. Average investment is initial outlay plus scrap value divided by 2. So $1.7 million plus $200,000 divided by 2 is $950,000. Accounting rate of return is therefore $97,500 divided by $950,000 equals 0.10, or 10%. The whole point of appraising this opportunity is ultimately to see if we want to go ahead or not, or if it will make our shareholders wealthier. Accounting rate of return is often compared to the company's overall return on capital employed, which is a similar measure to accounting rate of return, just for the whole business. A key point here is that shareholders, the owners of the business, often look at return on capital employed to help them understand how well the business is doing. Return on capital employed is profit before interest and tax divided by capital employed. The rationale is this: if a project has a potential return higher than the current return on capital employed, taking it on may well therefore increase the return on capital employed. This is the main reason why it's common in practice. Accounting rate of return has several advantages as an investment appraisal technique. First of all, it's a percentage measure, and managers like percentage measures as they can easily be compared to alternatives. Secondly, it's completely in tune with something that shareholders look at anyway: return on capital employed. It makes perfect sense for management to manage return on capital employed by considering the accounting rate of return of individual projects. Finally, in contrast to payback period, which we'll come to later, accounting rate of return does consider the whole life of the project. However, there are several serious disadvantages associated with this investment appraisal technique. As a percentage measure, it does not give us a direct measure of the impact on shareholder wealth as a result of taking on the project. It doesn't take into account the time value of money, the fact that money received later is actually worth less than money received today. Don't worry, I'll come back to this concept later. If there's a small trickle of cash flows at the end of the project for a few years, this can unreasonably drive down the accounting rate of return measure. For example, if we had an extra 10 years where we earn $1 a year, this would drive down the average accounting profits. However, the last 10 years of cash flows are completely insignificant to the project and so should be ignored. As we've seen, there are several good reasons why accounting rate of return is a common measure for investment appraisal. However, be aware that it has several serious theoretical flaws. In the next video, we'll go on to look at payback period. Hello. In this video, we're going to have a look at the concept of relevant cash flows and see how this applies to another investment appraisal technique, payback period. When we're making a decision about whether or not to invest, the amount to include in the appraisal should be future, incremental cash. The reason for this is as follows. Firstly, let's consider the significance of the word future. When we're making decisions, we're concerned about how that decision will affect the future. Anything that happened in the past cannot be changed, so should not be considered further in the decision itself. For example, suppose I commission an investigation into a project, and that investigation cost me $1 million. When I read the report, it says, if you invest $1,000 today, you'll get $2,000 back tomorrow. Am I upset that I've paid $1 million for this advice? You bet I am. But does that mean I don't invest $1,000 today to get $2,000 back tomorrow? I can't change the fact the report has cost me $1 million, so the cost of the report is irrelevant to the decision. The only decision we face is whether or not to invest $1,000 today to get $2,000 back tomorrow. 100% return in 24 hours sounds pretty good to me. Next, let's consider the significance of the word incremental. We're only interested in understanding how a decision will change the future. Financial accountants often struggle with this concept. For example, if you are paid $50,000 a year and your manager says to you, I need you to work on this project for a year, it will take up 1 day of your 5-day week each week. When you're considering the relevant cost of your time, it's very tempting to say something like $50,000 divided by 5 equals $10,000. So $10,000 is the relevant cost of my time on this project. However, In actual fact, you were paid $50,000 before and you continue to be paid $50,000. So the incremental cost of your time is zero. Opportunity costs and benefits are also relevant. Suppose we have some material in the warehouse that we bought for a project a while ago that didn't go ahead. Suppose it cost $1,000 to buy, and we have no further use for this material other than for a project we're considering. If we don't get on with the project, we could sell the material for scrap for $100. Let's consider the relevant cost of using this material on the project. Firstly, the $1,000 is irrelevant, as it's a historical cost and therefore sunk. If we don't go ahead with the project, we could sell this material for $100. So if we do go ahead, we'll be choosing to forego $100 income. In effect, using the material on the project has cost us $100, as we're $100 worse off as a result of going ahead. Finally, let's consider the significance of the word cash. In short, you can't spend profits. We make shareholders wealthier by giving them cash. So, when the company spends cash, it is at that point that it has cost the shareholder, as we can no longer give it to them. Equally, when cash flows into the business, this makes shareholders wealthier. Hence, we focus on cash flows. A good mental image to maintain when trying to decide on the size and relevance of a future incremental cash flow is as follows. Imagine a cash flow forecast of the business if you don't go ahead with the decision you are considering. And then, next to it, imagine a cash flow forecast of the business if you do go ahead with the decision. Anywhere there's a difference between those two cash flow forecasts, and the size of that difference is the relevant cash flow. In the previous video, we introduced the idea of accounting rate of return as a method for appraising a potential investment opportunity. Let's now have a look at the second non-discounting technique, payback period. The payback period for a project is the time it takes to recover its initial investment. It's the time it takes for the project to pay for itself. Let me remind you about the example we looked at in the previous video. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000. And Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. Key to calculating payback period is to calculate a cumulative cash flow column over time as follows. The scrap proceeds from selling the machinery are only received right at the end of the project, at the end of Year 4. The project pays for itself before the scrap proceeds are received, hence we don't need to include them in this analysis. The project pays for itself in the final year. At the start of that final year, the project still owes us $250,000. During that final year, $440,000 flows in over the year. Assuming that money flows in evenly, we could work out how far into that year we have to go in order to reach payback. We would need to go $250,000 over $440,000, or 57% of the way through that year. In other words, 57% times 12 months equals 6.8 months into that year. The payback period is therefore 3 years and 6.8 months. In order to decide whether or not to proceed, the payback period calculated needs to be compared to some relatively arbitrary benchmark. For example, the company may say, we only accept projects that pay back within 3 years. in which case we'd reject this project as it takes longer than 3 years to pay back. Payback period has several advantages as an investment appraisal technique. It's cash flow based as opposed to accounting rate of return, which is based on accounting profits. Accounting profits can be manipulated, and cash flow more directly relates to the fundamental objective of maximizing shareholder wealth. It also gives the decision maker a feel for how risky the project is. A project that pays back quickly is likely to be less risky, as the near future is simply more knowable than the distant future. Payback period is also useful if the company is facing cash flow difficulties, as it shows how long the project has to be financed for. However, payback period also has several disadvantages. It takes no account of the time value of money. More on this later. And it ignores all cash flows after the payback period has been reached. For example, a project may have a really fast payback, but then soon after the payback period has been reached, there could be an enormous outflow to decommission the site. Overall, the project could be very poor in terms of its financial performance, even though it has paid back quickly. In this video, we've considered how to identify the relevant cash flows in an investment appraisal decision that is cash flow based. We use the 3-line test of future, incremental, cash flow. We've also considered a second investment appraisal technique, payback period, its calculation, advantages and disadvantages. In our next video, we turn our attention to the time value of money. Hello. In this video, we'll consider the time value of money. This is fundamental for the calculation of net present value and internal rate of return. $1 today is worth more than $1 in 3 years' time. There are 3 reasons for this. Firstly, inflation. You can buy more with $1 today than you could with $1 in 3 years' time, as prices tend to increase periodically. Secondly, interest. You could put $1 into a bank account today, and over 3 years, it would accumulate interest to grow into something bigger than $1 in 3 years' time. Finally, risk. $1 today is a definite dollar, whereas the promise of $1 in 3 years' time is never going to be quite as certain. This is sometimes known as the bird in hand principle, from the old expression, a bird in the hand is worth 2 in the bush. Firstly, let's consider the mechanics of compound interest. This can be considered as interest accumulating on a deposit in the bank. Suppose we put $1,000 on deposit today into an account that will earn us 10% a year. In 1 year's time, this will be worth $1,000 times 1.1, the 0.1 is for the interest, equals $1,100. By the end of the second year, the balance would be $1,100 times 1.1 equals $1,210. By the end of the third year, the balance would be $1,210 times 1.1 equals $1,331. This calculation can be done in one go as follows. $1,000 times 1.1 cubed equals $1,331. Or, in general terms, the present value times 1 plus r to the n equals future value, where r is the annual rate of interest and n is the number of years. Now, this is all well and good, but usually with investment appraisal, we estimate future cash flows and are more interested in knowing what their present value equivalent is right now. In other words, we'd like to know how much we'd have to put into the bank today for it to grow into that future value. This tells us what that future value is worth to us right now. Restating these future values to a present amount is known as discounting, and this is simply the opposite of compounding that we've already seen. For example, the present value of $1,331 received in 3 years' time at an interest rate of 10% would be $1,331 divided by 1.1 cubed equals $1,000. In general terms, the present value equals the future value divided by 1 plus r to the n, where r is the annual rate of interest and n is the number of years. This can also be written as follows. The present value equals the future value times by 1 over 1 plus r to the n. The term 1 over 1 plus r to the n is called a discount factor. Discount factor tables are provided for you in the exam, so you can look up the value of this term without having to calculate it. For example, the 10% 3-year discount factor would be calculated as 1 over 1.1 cubed equals 0.751. Alternatively, this can be looked up on tables as follows. Get used to using these tables, they save loads of time. So, now we can calculate the present value of a future amount. This is saying what the future amount is worth in today's terms. Sometimes, cash flows repeat each period over several periods. For example, we might have $100 received each year for the next 3 years. A constant cash flow received each period for a fixed number of periods is called an annuity. To calculate the present value of this annuity, we could discount each cash flow individually and add them up as follows. We'll continue to assume the annual rate of 10%. So, the present value of this 3-year annuity is $248.60. A quicker way to do this would be to use an annuity factor. An annuity factor is simply the sum of the individual discount factors. In this case, the 10% 3-year annuity factor is 0.909 plus 0.826 plus 0.751 equals 2.486. So an alternative calculation would be $100 times 2.486 equals $248.60. Better still, annuity factors are available in tables too, and these are provided in the exam. Because discount factors are rounded to 3 decimal places, when we added the 3 together, it created a small rounding error. This is the only reason why the table showed 2.487 and we had calculated 2.486. Either would be acceptable in the exam. The annuity tables assume that the first payment under the annuity will be in 1 period's time. This may not be the case. For example, it may start in 4 years' time. This doesn't mean, however, the tables can't be used, so long as you remember that an annuity factor is simply the sum of the individual discount factors. Suppose then that our 3-year $100 annuity starts in 4 years' time. The present value will be $100 times annuity factor from years 4 to 6 at 10%, where the annuity factor from years 4 to 6 at 10% is the 3-year annuity factor starting in 4 years' time. We can calculate the annuity factor as follows. We take the 6-year annuity factor off tables at 10%. This is 4.355. But we don't need the first 3 years. So, if we deduct the 3-year annuity factor, which is 2.487 for years 1 to 3, from the 6-year annuity factor, which is 4.355 for years 1 to 6, that leaves us with 4.355 minus 2.487 equals 1.868 for years 4 to 6. So the present value would be $100 times 1.868 equals $186.80. Occasionally you might need to use an annuity factor that's not given to you in tables. The formula to calculate an annuity factor is shown above the tables in the exam. It is possible to have an annuity that actually never comes to an end. This is known as a perpetuity. The discount factor for a perpetuity is simply 1 over R. For example, the present value of $1,000 each year starting next year forever with a 10% per annum required rate of return would be $1,000 multiplied by 1 over 0.1 equals $10,000. This makes sense now we've got the answer in front of us. If we invested $10,000 into a bank account today in a world with 10% interest rates, we could withdraw $1,000 each year forever. This recreates the perpetuity cash flows. Technically speaking, a perpetuity factor is the sum of the individual discount factors from 1 to infinity. It's useful to remember this if the perpetuity doesn't start immediately. If it doesn't start straight away, the approach we'd use will be similar to that we would use for an annuity. For example, if our $1,000 perpetuity didn't start for 4 years, then the present value would be $1,000 multiplied by 1 over R minus the annuity factor for years 1 to 3 at 10%, or $1,000 multiplied by 10 minus 2.487 equals $1,000 times 7.513 equals $7,513. Time value of money calculations are at the very heart of net present value and internal rate of return, our remaining last two investment appraisal techniques that are far and away the most important two on the syllabus. It's very important, therefore, that you get to grips with these mechanics now. You don't have time to be thinking through the detail in the exam. It needs to be second nature by that point. Give yourself plenty of time and question practice. In the next video, we'll start to look at net present value. Now we've got to grips a little bit with the time value of money calculations, we can have a look at the last two investment appraisal techniques: net present value, or NPV, and internal rate of return, or IRR. With NPV, the basic approach is to estimate the future incremental cash flows associated with an investment opportunity and restate all those future amounts to present value equivalents by discounting them. If we then add them all up, and if the answer is positive, then the project has a positive value in today's terms. Let's go back to our earlier example. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000, and Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. Now, let's work out the NPV for this project. Let's set up a table and fill in the cash flows. Next, we add discount factors from tables as follows. Let's assume we have a time value of money of 10% per year. Note, the T0 discount factor is always 1. There's no need to discount this value as it's a cash flow happening today. In effect, it's already stated at its present value. Also, to enable us to do discounting calculations, we have to make a simplifying assumption about the timing of cash flows. We need to assume that cash flows that arise over a period of time arrive at the end of that period. So, for example, the Year 1 cash flows of $300,000 may well arise evenly over that first year. We'll assume that it all arrives in one go, all at the end of that year, at T1. Then, multiply the discount factor by the cash flow to work out the present value of each cash flow. Finally, add up all the present values to get the NPV. We picked on 10% as the discount rate here for an example. The discount rate that should be used for investment appraisal is the investor's required rate of return, also known as the cost of capital. We'll come back to how we calculate this much later on in the course. Let's just take it as a given for now. The basic decision rule for an NPV assessment is that if the answer is positive, the project should be accepted. This is because the value of all the cash flows restated to present values is net positive. In other words, accepting the project will add to shareholder wealth. In this case, the NPV is negative, and this would suggest the project should not be undertaken, because to do so will reduce the value of the business by $85,300. NPV has much to commend it as a technique. First and foremost, it gives a direct answer to the question, what will be the impact on shareholder wealth if I take this project on? For example, an NPV of positive $100,000 means that if that project is taken on, shareholder wealth will be increased by $100,000 in today's terms. The value of the company's shares logically should increase by this amount in total. NPV is based on cash flows and considers the whole life of the project. However, it also has its disadvantages. It's not used that often in practice because it's not well understood by non-finance professionals. Alternative measures like accounting rate of return and payback period are more immediately accessible to understand. It needs a cost of capital to be able to calculate it. This is the discount rate that's used. This is relatively subjective and difficult to calculate, as you'll see later on. It assumes that cash flows arise at the end of the period. Operating cash flows often arise throughout the period. Before we move on to look at the internal rate of return, or IRR, let me briefly return to the payback period approach. One of the downsides associated with payback period was, we said, that it does not take account of the time value of money. We can modify the technique slightly to include discounting by discounting the cash flows first before working out when the cumulative cash flow returns to zero. This is known as discounted payback period or adjusted payback period. For example, suppose a project requires $1,000 investment today and will generate $390 each year for 5 years. The discounted payback period would be calculated as follows: time, cash flow, discount factor, multiply the discount factor by the cash flow to give present value, and work out the cumulative present value as it builds up over time. We can see in this example that the discounted payback period is approximately a little over 3 years. Lastly, let's now consider our final investment appraisal technique, internal rate of return, or IRR. IRR is closely related to NPV. It's the discount rate that yields an NPV equal to 0. If we took the cash flows associated with a project and did several different NPV calculations at different discount rates and plotted the results on a graph, it might look something like this. The more heavily we discount future flows, the less they are worth in present value terms, and the lower the NPV becomes. The IRR is where this curve crosses the x-axis. This is the discount rate where NPV equals 0. The way we interpret the IRR is as follows. If the IRR is greater than the cost of capital, then we would accept the project, because this implies that at the cost of capital, the project has got a positive NPV. Let's see why this is the case on the graph. With similar reasoning, if the IRR is less than the cost of capital, we would reject the project, as this implies that at the cost of capital, the project has got a negative NPV. IRR is sometimes known as the break-even cost of capital, because that is the discount rate at which the project breaks even. In other words, where it has a 0 NPV. So, to recap, compare the IRR with the cost of capital. If the IRR is greater than the cost of capital, then accept the project. If the IRR is less than the cost of capital, then reject. Let's have a look now at how we actually calculate the IRR. We actually estimate the IRR using a process known as linear interpolation. The process is as follows. Calculate the NPV at two different discount rates. It doesn't really matter what the rates are, just use ones off tables like 5% and 10%. What we will have done then is find 2 points on the curve as follows. Mathematically, we will draw a straight line between these 2 points. Approximately, where the straight line crosses the x-axis is more or less where the curve crosses the x-axis. We can work out exactly where the straight line crosses the x-axis. Let's label the graph first. A is always the lower percentage. B is the higher percentage. NA is the NPV at A%, and NB is the NPV at B%. And combine them together in this formula. You have to learn this formula for the exam. It's not given to you on the formula sheet. However, it may help you to remember it if you do the following. Starting with the A and read across, the formula spells out a banana NB. Let's calculate the IRR of our earlier example. Here's the project in question. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000. And Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. The NPV at 10% was negative 85.3. If we rerun the NPV calculation from earlier on at 5%, we get the following. So, the IRR must be somewhere between 5% and 10%. Let's apply the formula. So the IRR is 8%. If the firm's cost of capital was 10%, we should reject this project as its return is less than the cost of its finance. You don't need to have a positive and a negative NPV for the formula to work. Suppose you picked 5% and 10% as discount rates and they both came out with positive NPVs. The formula will still work. All it's doing is the following. This is known as extrapolation. It's technically not quite as accurate as what we did before, but it's still perfectly acceptable for our exam. You'll notice that the black line is still pretty close to the curve on the x-axis. IRR has several advantages. It's a percentage, and managers like percentages because they can easily be compared to other alternatives. It's based on cash flows and includes the time value of money. You don't need to know the cost of capital precisely to use it. For example, if you feel your cost of capital is somewhere between 5 and 10% and you calculate the IRR as being 18%, then you'd be safe in saying let's go ahead, as 18% is higher than the entire range from 5 to 10%. However, there are some problems with IRR. As a percentage measure, it always begs the question, percentage of what? For this reason, you cannot use it to compare two different projects. For example, suppose Project A has an IRR of 40% and Project B has an IRR of 20%. It looks like Project A is preferable. However, suppose I now tell you that Project A gives you a 40% return on $1 and Project B gives you a 20% return on $1 million. Clearly, Project B would make you wealthier, but IRR indicated Project A. We're assuming with the basic decision rule that the project involves an initial outflow followed by years of inflows. This is known as a traditional project. This is what gives the curve on the IRR graph its downward slope from left to right. Other types of projects will yield different shaped curves, hence the decision rule would need to change. For example, if a project consisted of an initial outflow, several years of inflows, and then a big outflow at the end, such as site cleanup costs, then the IRR graph may look like the following. And that's just one example. There are many possible graphs depending on the pattern of the cash flows of the project, which makes the basic decision rule of if the IRR is greater than the cost of capital, then accept the project unreliable. One final disadvantage of IRR, and this is a technical point. The IRR calculation assumes the cash flows that are generated early on in the project are reinvested at the internal rate of return. This is known as the reinvestment assumption. There's no reason to assume that this will be the case. Cash flows that are earned early on in the project are generally extracted from the project and something else is done with them. Investment appraisal, and especially NPV, is a highly examinable topic. Take time to get grips with it as a subject and work through plenty of question practice. We'll continue to build on the NPV idea in the coming videos. Hello, in this video we'll build upon the earlier concept of NPV and consider some of the more advanced issues that you may have to deal with in the exam, namely tax, inflation and working capital. In longer questions, a more orderly pro forma helps you to deal with the volume of information and also helps the marker to allocate marks to your answer. Remember, this is management accounting, so the pro forma is not prescribed in law and standards in any way. You just need to be aware of the general structure and a few principles. Start by putting time across the top. If the question tells you it's a 5-year project, put a 6th year in there. Often tax effects spill over into an extra year. If you don't use that final column, it doesn't matter. Better to do that than to squeeze in an extra column later that you realise you might need. Go to the bottom of the page and put some subtotals. Net cash flow, discount factor, and present values. Give yourself plenty of room, use a whole page. Then put cash flows down the side and populate the table as you go. For reasons that will hopefully become clear later on, it helps if you can put cash flows of income-related items such as sales, materials purchases, rent, payment to workers towards the top of the page, as this will gather things nicely to do a subtotal for corporation tax. Items that don't appear in an income statement should be put further down. Then, in the exam, start off with the easy numbers and put those in the pro forma and work your way up to the harder numbers. If you can't do the harder numbers or you're running out of time, make a simplifying assumption. This exam is method marked, which means even though you won't get any marks for that number being correct, you get credit for how you use that number later on. If you use the wrong number in the right way, you get the marks later. Let's now consider the impact of tax. Remember that this is not a tax exam. In this exam, we take a very simplified approach, simply to appreciate that taking on projects will impact our tax bills. There are generally 2 aspects to tax to consider: corporation tax and capital allowances, also known as writing down allowances. You need to read the question carefully, as it will tell you exactly what the treatments are to be. Let's start off by considering corporation tax. Usually the question will say something along the lines of, the corporation tax rate of 25% is charged on operating cash flows and is paid in the same year that the cash flows occur. This being the case, then any operating cash flows, such as sales, purchases, payments to workers or factory rent, should be put towards the top of the pro forma So a subtotal can be performed like this. I'm making numbers up as I go here just to show you how it all works. Once we've got the subtotal, it's simply a case of multiplying by the percentage tax rate given in the question and slotting the number into the right column. If in this question the tax rate was 25% payable in the same year in which the cash flows occur, we will calculate tax and add it into the pro forma as follows. If, on the other hand, the question had said something like tax is payable at 25% 12 months after the end of the year to which the cash flows relate, we would simply delay the cash flows by a year as follows. Writing down allowances, or capital allowances, is tax allowable depreciation. The capital allowance itself is not a cash flow. The cash flow is the saving in tax we benefit from as a result of having it. Let's work through an example together. Suppose our fictitious company needed to invest $250,000 at the start of the project, and this was eligible for writing down allowances at a rate of 25% reducing balance per annum. Suppose as well that the scrap value at the end of the project was $75,000. Before you get into the writing down allowances, let's include those two amounts on the pro forma. Here's a standard working to calculate the tax saved as a result of the writing down allowances. Let's set up the column headings first. Time, written down value, tax saved, and timing. Let's now calculate the first year. We take 25% of the initial cost of $250,000. This is $62,500 and is effectively depreciation for tax purposes. If we deduct this from the $250,000, we get the written down value of the asset at the end of that first year. The depreciation for tax purposes is not the cash flow, but it will appear on our tax return as an allowable deduction. This $62,500 allowable depreciation saves us tax at a rate of 25%, our corporation tax rate. So $62,500 times 25% equals $15,625. Assuming that corporation tax is paid at the end of the year to which the cash flows relate, the tax saved because of this first writing down allowance will be received at the end of that first year, which is T1. We work through a similar process for years 2 and 3 as follows. For the final year, you need to read the detail of the question to see what happens. However, usually there's a balancing allowance or balancing charge in that final year. This is the equivalent of a profit or loss on disposal for tax purposes. It's easier to see this through an example, so let's see what would happen in this case. We said the scrap proceeds of this investment was $75,000. We compare this to the tax written down value of $105,469. The difference of $30,469 is the equivalent of a loss on disposal for tax purposes. This is known as a balancing allowance. If it had been a profit on disposal, it would have been a balancing charge. Again, this balancing allowance of $30,469 is not a cash flow itself. It would appear on a tax return as an allowable deduction. The amount of tax this saves depends on the corporation tax rate, in this case 25%. So the cash flow benefit of the writing down allowance, or the balancing allowance in this case, is $30,469 times 25% equals $7,617, receivable at T4. We can now transfer these cash flows into our main pro forma. Next, let's have a look at working capital. Working capital is an investment that's required to have a project operating in the first place. For example, without any inventory, there won't be any raw materials to turn into the finished product. We have to buy this inventory in advance, so it's therefore a use of cash at the start of the project. Suppose that in our example the question states working capital equivalent to 10% of sales for that year needs to be in place at the start of that year. Let's work out the cash flow together. First of all, let's set up a pro forma working with time across the top. Just to remind ourselves how much sales occur in each year, let's also add sales as a memorandum row. Now let's work out how much working capital we need to have in place at the start of each year. Remember, for example, that the first year happens between T0 and T1. T0 is therefore the start of the first year and T1 is the end of that first year. Remember, we have sales of 100 at T1 as a simplifying assumption because we assume that cash flows that arise over a year arise at the end of that year. So we take 10% of sales for the year and note that down as needing to be in place for the start of that year as follows. Note that these are not the cash flows themselves. This represents the working capital that needs to be on the statement of financial position. It's only the movements from one period to the next that equate to a cash flow. For example, moving from year 1 to year 2, we need to have an extra 10 to take our working capital up to 20. In other words, take increments as follows. You'll notice if you add across the cash flow row, it sums to 0. This is a useful check in the real exam. All this means is that money that's invested in working capital ultimately comes back out at the end of the project. That's not to say it has a neutral effect on the value of the project, because these cash flows will need to be discounted. In other words, there is a finance implication associated with investing the money up front to get back later. We can now add these cash flows to our main pro forma. Assuming that we've now covered all the cash flows given to us in the question, we can complete the pro forma by doing the following. Add down each column to give us net cash flows. Add in the discount factors. Let's suppose here that the discount rate given to us in this question was 10% per annum. Remember, use tables to get these. Then multiply the net cash flow by the discount factor to give present values and add it all up. Last but by no means least, conclude by interpreting the answer. In this case, I might say something like, the NPV is 155 positive and therefore the project should be accepted, as to do so will increase shareholder wealth. Finally, let's consider the impact inflation might have in a question. Inflation affects both the cash flows and the cost of capital. Inflating prices increases cash flows. However, you may recall that the cost of capital is there to compensate investors for three things: interest, inflation, and risk. So inflation also increases the cost of capital. In principle, there are two possible approaches here. Either you leave inflation out of the cash flows and leave inflation out of the cost of capital, or you include inflation in the cash flows and you include inflation in the cost of capital. Either way, in theory, gets you to the same result. However, in the main, for reasons I won't bother you with at the moment, it's usual in longer questions to include inflation in the cash flows and make sure inflation is included in the discount rate. Let's work with an example. Consider these cash flows for sales. T1, 100, T2, 150, and T3, 200. Let's assume these cash flows are in real terms. In other words, they are stated at today's prices and therefore don't include inflation. Let's assume that in this world, inflation is running at 3% per annum and that the uninflated cost of capital, also known as the real cost of capital, is 7% per annum. First, let's inflate the cash flows. we multiply the cash flows by 1 plus I to the n, where I is the annual inflation rate and n is the number of years, like this. These inflated amounts represent the cash that will actually be received. Let's turn our attention now to the cost of capital, or the discount rate. If in our world here I ask you to give me $100 and in return I give you back $107 in 1 year's time, I have given you a 7% return for that year. Unfortunately though, prices go up over the year, so you won't be able to buy 7% more stuff with the money I give you back. If I want to give you a real return of 7%, this means I want you to be able to buy 7% more stuff at the end of the year. So, if inflation is running at 3%, I would need to give you 100 multiplied by 1.03 equals $103 at the end of the year, just so you haven't suffered from inflation. With $103, you could buy the same stuff at the end of the year with your money that you could at the start of that year. If I want you to be able to buy 7% more stuff at the end of the year when there's 3% inflation, I'd need to give you $103 times by 1.07 equals $110.21. In general terms, 1 plus I equals 1 plus R times 1 plus H, where I is the inflated cost of capital, also known as the money or nominal cost of capital. R is the uninflated cost of capital, or the real cost of capital, and H is the inflation rate. This formula is given to you in the exam. In this case, 1 plus I equals 1.07 times 1.03 equals 1.1021. So I equals 1.1021 minus 1 equals 0.1021, or 10.21%. 10.21% is the inflated, or money or nominal, cost of capital. So, back to our question. We would discount the inflated cash flows at the inflated discount rate. 10.21 is pretty close to 10%, so let's use 10%. That gets us close enough to the answer, and we can use tables. We discount the inflated cash flows at the inflated discount rate of 10% to give us our present value like this. Just to prove the answer comes out the same if we discount the uninflated cash flows at the real rate of 7%, this $387.65 compares to the $389.40 from before. The difference is very minor and is due to rounding. Remember, we assumed an inflated discount rate of 10% instead of using the precise 10.21%. The difference is in fact insignificant and would be more than acceptable in the exam. Often in longer questions, different inflation rates may relate to different types of cash flows. In this situation, you inflate the cash flows at their own individual rate and then discount them all back at an inflated cost of capital. The inflation rate that you would use to calculate the cost of capital in this case would be general inflation, such as the Consumer Prices Index or Retail Prices Index. Also, sometimes in longer questions, some cash flows are given in today's prices and others are already inflated. In this case, you need to make sure that everything is an inflated cash flow and then discount back using an inflated cost of capital. Alternative terminology for the inflated cost of capital is the money cost of capital or nominal cost of capital. It is for these reasons and others that the general approach in longer questions is to ensure that all the cash flows in your NPV pro forma include inflation and to discount them at the inflated cost of capital. During this video, we've climbed the heights of difficulty as far as advanced net present value calculations are concerned. You should practice longer questions to ensure you're happy with these concepts. We're now going to go on and consider a variety of different questions that use the NPV concept in slightly different ways. Hello. In this video, we'll be considering how to deal with questions that involve a capital constraint, known as capital rationing problems. We may have loads of good ideas for projects to do, all with positive NPVs, but not enough capital to invest. We'll consider how we decide which projects to do. Firstly, let's consider why we have a constraint in the first place. The capital constraint can be described as hard, which means it's externally imposed. This means the money isn't there and that it can't be obtained in time. It could also be described as soft, which means it's internally imposed. This generally means the money is there, but self-discipline means the company doesn't want to spend it all. It may, for example, want to put some aside in case of difficulties. Often, businesses put together a capital expenditure budget to limit their spending on capital expenditure. This isn't to say that if they spent a little more than that, the business will be in financial difficulty. It's just that the company may not want to spend every last penny it has on new projects. To be honest, whether the capital constraint is hard or soft doesn't change the numbers. Either the money's not there, or it is there and the company doesn't want to spend it. Let's work with an example. Suppose the company's identified 4 projects with the following profiles. Now suppose it only has $300,000 to spend. It can't do all the projects, as this would cost a total of $575,000. Assuming that the projects couldn't be delayed and all avenues for finance have been explored, let's consider how it will decide what our investment plan will be. Firstly, we need to know if the projects are divisible or indivisible. A divisible project means that you can do, for example, 40% of the project for 40% of the investment and get 40% of the NPV. For example, if you were buying a chain of shops, you could buy the whole chain or potentially 40% of it. With indivisible projects, it's either all or nothing. For example, investing in a machine to create a new product. You either invest in the machine or you don't. 40% of a machine is not a machine, it's scrap metal. The question will guide you as to whether the projects are divisible or not. Suppose in our example the projects are divisible. The approach we take to solving this problem is very similar to limiting factors that you may recall from earlier studies. We want to direct our investment, when we have limited capital available, to ensure that we maximise the NPV per dollar invested. So our key calculation is to divide the NPV by the initial investment, sometimes known as the profitability index, to help us rank our projects from most favourable to least favourable. For example, for project A, the profitability index is 50 divided by 100 equals 0.5. And for the other projects, we then rank the projects from the highest profitability index down to the lowest, as follows. As we can see, project C is our preferred starting point. It has the highest profitability index because, as we can see, it gives us the greatest NPV per dollar invested, which is an important consideration when you don't have that many dollars available to invest. Let's set up a pro forma for our investment plan. We'll start off at the top of the rankings and work our way down until we've run out of money. In total, we have $300,000 to spend. Let's put that at the bottom of our working. We can afford to do 100% of Project C as we have $300,000 to spend, and the full Project C only takes $125,000. That leaves us with $300,000 less $125,000 equals $175,000 left to spend. So we move on to Project B, which was ranked number 2 on the list. We can also afford to do 100% of Project B, as we have $175,000 left to spend, and the full Project B only takes $150,000. This leaves us with $175,000 less $150,000 equals $25,000. Next on the rankings is Project D. We cannot afford to do a whole Project D as that will take $200,000 and we only have $25,000 left. However, we can afford to do 25 over 200 equals 12.5% of a Project D. Remember, these projects are divisible. This means it will cost us 12.5% times $200,000 is $25,000, and we assume that will generate an additional NPV of 12.5% times $130,000 is $16,250. This means, therefore, that the highest NPV we can generate if we have a capital constraint of $300,000 is $216,250. This is the total of the NPV column. In summary, if the projects are divisible, then we'd want to do 100% of Project C, 100% of Project B, and 12.5% of Project D. If the projects are indivisible, then the only approach we can use is to look at all possible combinations of positive NPV projects, trying to spend as much money as possible, and see which combination gives us the highest NPV. For example, here we could do A plus B, which will give you 150 NPV, or A plus C, which would also give you 150 NPV, B plus C, which gives you 200 NPV, or A plus D, which will give you 180 NPV. So the combination of projects B and C give the highest NPV when the projects are indivisible, and this NPV equals $200,000. We've considered here the impact of having capital constraints and how D company can decide what to invest in to maximum effect. The company should make sure that it is definitely constrained as far as the amount of capital available is concerned before turning away positive NPV projects. It could consider, for example, delaying a project, leasing the assets, or trying to raise more finance. In our next video, we'll consider replacement analysis. Hello. In this short video, we'll be looking at replacement analysis. This is where a company may, for example, need a delivery van in its business and it thinks it may always need one. The question we're considering here is how often should it be sold and replaced with a new one. We'll work with an example here. Suppose the delivery van costs $10,000 brand new and the company is trying to decide whether to replace the van every 2 or every 3 years. It costs $1,000 to maintain in the first year, $2,000 in its second year, and $2,500 in its third year. If the van is sold after 2 years, its scrap value is $4,000. After 3 years, its scrap value is $2,500. The cost of capital is 10% per annum. Let's first of all work out the net present value of each replacement cycle, starting with the 2-year cycle. If we buy the van, run it for 2 years and then sell it for scrap, the net present cost of ownership would be calculated as follows. The initial cost, the maintenance costs, the scrap proceeds, all discounted at 10%, gives us present values and an overall net present cost of $9,257 for the 2-year period. Let's now consider the 3-year cycle. If we buy the van, run it for 3 years and then sell it for scrap, the net present cost of ownership would be calculated as follows. The initial cost, the maintenance costs, the scrap proceeds, all discounted at 10%, gives us present values and an overall net present cost of $12,561 for the 3-year period. So, in summary, the net present cost of a 2-year cycle is $9,257 and the net present value of a 3-year replacement cycle is $12,561.
It's very tempting to say, given that these are costs, the 2-year cycle is obviously cheaper, so we should go for that. However, this is analogous to saying that if I buy a brand new car and it suffers $10,000 depreciation in 1 year and a total of $15,000 depreciation over 2 years, that I'd rather suffer $10,000 depreciation than $15,000 depreciation, so I should replace my car every year. It's a good way to talk yourself into getting a new car, but it's not correct because we aren't comparing like with like. It'll be more reasonable to say if I replace my car every year, I suffer $10,000 depreciation every year, but if I replace my car every 2 years, I suffer the equivalent of $15,000 divided by 2 equals $7,500 depreciation a year. So I should in fact replace my car every 2 years. What we've done here is compare the equivalent annual depreciation cost of owning the car for 2 years versus 1 year. The equivalent comparison can be done with net present values by dividing the NPV of a replacement cycle by the cumulative discount factor or annuity factor for that number of years. In this case then, for the 2-year replacement cycle, the equivalent annual cost will be calculated as follows. $9,257 divided by the annuity factor for 2 years at 10%, which, using annuity tables, is $9,257 divided by 1.736 equals $5,332 a year. The equivalent annual cost of ownership for a 2-year replacement cycle is $5,332. Incidentally, what this is telling us is that if we were to hire a van for 2 years and paid $5,332 rental at the end of each year, that'll have the same NPV of $9,257 cost. So you can think of equivalent annual cost as being the same idea as an annual rental charge. For the 3-year replacement cycle, the equivalent annual cost will be calculated as follows. $12,561 divided by the 3-year annuity factor at 10% equals $12,561 divided by 2.487 equals $5,051 a year. The equivalent annual cost of ownership for a 3-year replacement cycle is $5,051 a year. Again, you can think of this as being an equivalent annual rental cost for a 3-year cycle. I would rather pay $5,051 a year compared to $5,332 a year. In other words, the 3-year replacement cycle is more economical. In this video, we've explored how to tackle replacement cycle questions. The key thing to remember here is that you can't compare NPVs of different replacement cycles directly as they relate to different periods of time. You need to divide each NPV by the annuity factor for the length of that cycle to convert the NPV into an equivalent annual cost. Equivalent annual costs can be compared directly.
Hello. In this video we'll be considering a couple of financing options for a project we've already decided to do. Suppose you've already done your NPV analysis, assuming that you're going to borrow the money and buy the asset involved in the project. We are now asking the question, could we improve the NPV of that project by leasing as opposed to buying the asset? It's important to note that we've already decided to go ahead with the project, so the actual operational cash flows the project generates is not relevant here. We're only considering the incremental cash flows of comparing leasing versus buying the asset. You need to read the question to find out exactly what the differences are between leasing and buying in the jurisdiction of the question. Typically, it will include the following. If you lease the asset, you pay rentals. These rental payments are incremental to the leasing option, as is the fact that you will receive a tax deduction when paying them.
that will be allowable for corporation tax purposes. If you lease the asset, you won't have to pay the initial cost of buying it, but you will also lose the scrap proceeds as you won't have an asset to sell at the end of the lease. Finally, if you lease the asset, you won't own it, so it's unlikely you'll be able to claim capital allowances. Let's work through a question to see how we tackle the situation. Suppose we're considering borrowing at an after-tax cost of 10% to buy an asset at a cost of $10,000 for a 3-year project. At the end of the 3 years, the asset will have a scrap value of $4,000. 25% writing down allowances are available on a reducing balance basis with a balancing allowance or balancing charge for the final year. Alternatively, you could lease the asset at a cost of $2,600 a year payable at the end of the year. This $2,600 is tax deductible. Corporation tax is payable at a rate of 30% per annum, payable in the same year as the cash flows that are being taxed. Should the company lease or buy the asset? There are two alternative approaches to dealing with a question like this. You could prepare two NPV tables, one for leasing and one for buying, and compare the two to see which is cheapest. Alternatively, you can prepare one table, which in one go compares leasing as opposed to buying. We'll have a look at both methods here. Generally, either are acceptable in the exam. First of all, let's have a look at the two-table approach. We'll start off by putting together an NPV table showing the cost of buying the asset. Time across the top, initial cost, scrap value, writing down allowances, we'll come back to this, net cash flow, discount factors at the after-tax cost of borrowing, learn this, to give us net present value. We calculate the value of the tax saved as a result of claiming writing down allowances in exactly the same way as we've seen already. Headings, the first writing down allowance, the second writing down allowance, and the balancing allowance in the final year. Now, let's get that into the NPV table for the borrow and purchase option. Let's now add up, multiply by the discount factor to give us the present values. If we add up the present values, we get a cost of, so negative, $5,483. Firstly, don't be put off by the fact that this is negative. We're only considering the cost of ownership. Secondly, you'll notice we don't put the loan that we take out as a cash inflow. We don't put the loan repayment as a cash outflow, and we don't even put the interest cost as a cash outflow. This is because it's all accounted for in the discount factor. That 10% represents the cost of financing this asset. Let's now have a look at the relevant cash flows associated with leasing the asset. Headings, rental costs, tax saving on the rental cost, add up the relevant cash flows, multiply by the discount factor. This is still the post-tax cost of borrowing of 10%, learn this, and add up the present value to work out the net present cost of the leasing alternative. So, the net present cost associated with buying the asset was $5,483. The net present cost associated with leasing the asset was $4,524. Leasing is therefore $5,483 less $4,524 equals $959 cheaper. All else being equal, we should therefore lease the asset. As mentioned earlier, this can be done through one table. We'll construct the table from the point of view of saying if we lease as opposed to buy the asset, Let's set up the pro forma first. If we lease as opposed to buy, then we will save the initial outlay, lose the scrap proceeds, lose the capital allowances, pay annual rentals and receive a tax deduction for doing so. We then add up all the relevant cash flows and multiply by the discount factor to give us present values, which we then add up to give us the NPV of leasing as opposed to buying. You'll notice that the answer is the same as before. Preparing a table that asks, should we lease as opposed to buy, has a positive NPV of $959, meaning that leasing as opposed to buying is a good thing to do. It is worth considering how you could possibly be better off to lease as opposed to buy, when presumably the company that leases you the asset is also making some money. There are several possible reasons for this. The leasing company may buy in bulk and therefore be able to buy the assets at a discount. The leasing company may have access to cheaper finance, for example if it's a bank. The leasing company may be prepared to take a small loss on the lease itself to encourage the sale to happen in the first place. Finally, sometimes leasing an asset may be the only way a business can finance the acquisition. For example, borrowing may not be possible if it has little to offer by way of security. In this video, we've compared leasing versus buying as two financing alternatives. Remember that the decision to go ahead with the project has already taken place, so there's no need to bring in the project cash flows. We're only considering how the cash flows change if we were to lease as opposed to buy. In this video, we'll have a look at how risk and uncertainty can be built into decision making by considering various techniques the decision maker may use, such as expected values, risk-adjusted discount factor, payback, and simulations. We'll consider sensitivity analysis and certainty equivalence in the next video. Technically speaking, risk and uncertainty are different things. Risk is quantifiable. We're dealing with known possibilities and known or estimable probabilities. An example of risk would be tossing a coin. We don't know whether it's going to be a head or a tail, but we know it's going to be one of those with a 50-50 chance of each. With uncertainty, either we don't know the probabilities and/or we may not know all the possible outcomes. This is therefore more difficult to quantify. Often, one person's risk is another person's uncertainty. If an individual has experience of a situation, they may well have an idea of what may happen and how likely it is to happen. This may not be the case if the situation is new to the individual. We often use the terms of risk and uncertainty interchangeably, but just bear in mind that technically they are different things. There are several ways of dealing with risk and uncertainty in decision making. Let's first consider the use of expected values. An expected value is an average. Suppose we're not certain what revenue will be next year. We think there's a 25% chance that it will be $100,000 and a 75% chance that it will be $200,000. The expected value for revenue next year is calculated like this: 25% times $100,000 plus 75% times $200,000 equals $175,000. If we were using expected values, we would use $175,000 as the figure for sales. This assumes a risk-neutral attitude. If the decision maker uses $175,000, from that point on they are no longer considering that sales could be as high as $200,000 or as low as $100,000. A little extreme perhaps, but imagine if the company will fail completely if sales were as low as $100,000. The decision maker, when using expected values, would therefore not be considering that there was a 25% chance of the company failing. Expected values are therefore a long-run average and are not suitable for one-off decisions. They're also highly dependent on the estimate of probabilities. Another approach that could be taken to deal with risk is to reflect it in the discount rate. Suppose a company's cost of capital is 10%, but it's considering undertaking a project that is riskier than their average. Remember that the cost of capital is there to compensate investors for three things: interest, inflation, and risk. So, if the project we're appraising is a higher risk than others, we can apply a higher discount rate, let's say 15%. It is possible to be more scientific than simply increasing it arbitrarily. More on this later in the course, when we have a look at the marginal cost of capital for investment appraisal. Payback period gives us a measure of risk. A project with a short payback period can be considered to be less risky, as the near future is more knowable than the distant future. We might be very concerned if it takes a long time to pay back, as the conditions that the project operates under could change more dramatically in the longer term than is likely in the shorter term. Lastly, in this short video, let's consider simulations. When we put NPV calculations together, we put our best estimates for what we think the cash flows will be into that calculation. For example, for sales, these estimates are what is known as point estimates. They're a number being used to represent a range of possible values. If we have the information, it would be more accurate to replace these point estimates with a fuller description of that variable. For example, by replacing that number with a probability distribution. We may replace one or two numbers, or we may replace all of them with probability distributions. Don't panic. You're not going to be asked to do the maths of this in the exam. You just need to be aware of this as a technique and be prepared to explain it. If some of the point estimates are replaced with probability distributions, the natural conclusion of this is that there won't be a single number at the end of the calculation for NPV. The NPV itself will be a distribution, perhaps like this. The decision maker would need to consider the graph and make their decision based on that. We can see here that the expected or average NPV is $10,000, but the NPV could be higher or lower than this depending on the value of the underlying variables. Although this technique is much more in-depth than using point estimates, it assumes you know the probability distributions, which we may well not do given that we're dealing with the future. In this video, we have considered the various tools and approaches that we can use when building risk into our investment appraisal decisions. There are two more to look at: sensitivity analysis and certainty equivalence, and we consider these in the next video. Hello, this is our last video in relation to investment appraisal, where we will complete our studies of how we build risk into decision making. We will be considering here sensitivity analysis and the use of certainty equivalence. Once we've calculated the net present value, sensitivity analysis turns to the estimates we made in the calculation, and for any one estimate asks the question, how wrong could I be before the decision changes? In other words, how much different from that estimate will the number need to be before it turns out that I made a mistake in my initial conclusion? If the answer is it has to be very different, I'm probably feeling reasonably comfortable. If it only has to be slightly different before the decision changes, I'm very sensitive to that variable. For example, let's suppose we have calculated the NPV for a project to be positive $50,000. Within the calculation, there was an estimate for the initial investment of $1 million. Our initial conclusion would be to go ahead with the project, given it has a positive NPV. In fact, we'd be happy to go ahead with the project, provided the NPV is not zero or negative. For every $1 increase in the cost of the initial investment, the NPV will fall by $1. In other words, initial investment could increase to $1,050,000 and the project would still be viable. At $1,050,000, That initial investment cost has increased by $50,000 and has therefore eliminated the positive NPV. The NPV would be zero. We would typically express the sensitivity with the following calculation. 50,000 divided by 1 million equals 5% sensitivity. A lower percentage sensitivity means that only a relatively small movement in the value of that variable will change the decision. In other words, a lower percentage means we are very sensitive to that variable. In more general terms, we can calculate the percentage sensitivity as follows. NPV of the project divided by NPV of the cash flows affected by the variable. Now, suppose we're interested in the sensitivity of our project's NPV to sales price. Revenues are, let's assume, $250,000 each year for 5 years. Corporation tax is at 30%. The cost of capital is 10%. As previously mentioned, the NPV of the project is estimated to be $50,000, and on that basis, we may well decide to go ahead as a preliminary conclusion. Let's now consider the sensitivity of our decision to sales price. The net present value of the cash flows affected by sales price is as follows. $250,000 before tax is worth $250,000 times 1 minus 30% equals $175,000 after tax each year for 5 years at a discount rate of 10%. The present value of after-tax revenue is therefore $175,000 times the 5-year annuity factor at 10%, which equals $175,000 times 3.791 equals $663,425. If, for example, sales price halved, NPV would reduce by 0.5 times $663,425 equals $331,713. So we can afford to lose 50,000 divided by 663,425 equals 7.5% of sales revenue before we reduce our NPV down to zero. In other words, if sales price falls by 7.5%, we will eliminate NPV. We are therefore 7.5% sensitive to sales price. The same approach can be taken with the vast majority of cash flows that have gone into the NPV calculation. The decision maker can then focus in on the variables they are more sensitive to make sure that their estimates are reasonable. There are a couple of exceptions to this though, sensitivity to the cost of capital and sensitivity to the life of the project. Firstly, let's consider sensitivity to the cost of capital. With our project, the NPV at 10% is $50,000. Do you remember what the internal rate of return tells us? It is that discount rate that yields an NPV equal to zero. Suppose for our project the IRR has been calculated at 14%. This means if our estimate for the cost of capital of 10% turns out to be wrong, it will change our decision if the cost of capital turns out to be 14% or higher, because at that point the NPV equals zero. In other words, we would need to be 14 less 10 divided by 10 equals 40% wrong. We are 40% sensitive to our estimate for the cost of capital. Finally, with sensitivity analysis, let's consider sensitivity to the life of the project. Our 5-year project has an NPV of $50,000 positive. Suppose we rerun the calculation as if the project was a 4-year project and the NPV turns out to be approximately zero if it only lasts for 4 years. The percentage sensitivity to the life of the project will be calculated as follows. 5 less 4 divided by 5 equals 20%. Although sensitivity analysis can be a useful guide to decision makers to focus their attention on the key variables in a decision, it does have its drawbacks. It only looks at one variable changing at a time. In reality, they'll tend to change together, A simulation may be more appropriate with more than one variable changing. It doesn't come with a decision rule. Does a sensitivity of 6% mean we don't go ahead? That's down to the judgment of the decision maker. There are no rules to help make the decision. Even though sensitivity analysis tells us how wrong we would need to be in order for the decision to change, nowhere in our analysis does it include how likely we are to be wrong. For example, on the face of it, a 1% sensitivity to price might be worrying to the decision maker. However, if they have a signed contract in place guaranteeing what the price will be should they go ahead, there is in fact no need to be concerned. Finally, let's consider certainty equivalence. This is something we tend to do naturally. Consider the receipt of $1,000 we may be receiving in a month's time. If you're absolutely certain it will arrive, we may include it in our forecasts as $1,000. If you're reasonably certain, but not absolutely certain it will arrive, we might include it at, say, $900. If we think it could possibly arrive, but we're not at all certain, we might include it at, say, $250. In effect, what we're doing here is restating the possible $1,000 as a certainty equivalent. For example, we're saying a possible $1,000 is worth the same as a certain $900, for example. Let's consider how this might be examined. Consider the following estimated forecast cash flows for revenue in a project. T1 $100,000, T2 $200,000, and T3 $250,000. Relevant certainty equivalent factors are as follows: T1 0.9, T2 0.8, T3 0.7. These certainty equivalent factors would need to be given to you in the question, or at least you would have to be given enough information to be able to work them out. Suppose the cost of capital is 14% and the risk-free rate of return is 10%. The risk-free rate is the rate of return required to compensate investors for interest and inflation only, i.e. no premium is included for risk. The present value using certainty equivalence will be calculated as follows. Start off by writing out the estimated cash flows. Multiply the estimated cash flows by the certainty equivalent factors. This strips out the risk from the cash flows and turns them into risk-free certainty equivalents. The certainty equivalents should then be discounted at the risk-free rate. There's no risk anymore in the cash flows, so we don't need a risk premium in the discount rate. There's nothing wrong with this calculation in principle, but in practice, the certainty equivalent factors cannot consistently be derived from anything objective. They will in effect be subjective, made-up numbers, which potentially undermines the accuracy of the overall answer. This brings us to an end of the investment appraisal part of the syllabus. Investment appraisal questions require a methodical approach. They're often quite numerically intensive, but with plenty of question practice and an orderly approach, they are eminently passable.